All right, it looks like we're back in action. Thank you guys for that. Again, my name is Brian Munson. I'll be your moderator today. I'm the Director of Membership Development here at NCBA CLUSA, and I help coordinate and cultivate our Associate Member Program, and as an extension, this Associate Member webinar series. We are here today to partake in. Before I give some quick background on the series, Castle Wealth Advisors and today's presenter, Gary Pittsford, just a quick bit of housekeeping. All phones will be muted during this call, so if you have a question, please type it into the chat box and we'll share it with the presenter at the conclusion of his presentation during our Q&A. As we just illustrated, we'll be recording the webinar for your convenience and we'll have it archived and available on our website. We will make sure to send everybody a link once it's been posted. And lastly, expect to see a post-event survey follow-up from NCBA CLUSA. We look for ways, obviously, to improve our webinar program and for any feedback that you might have. Moving on, a quick few notes about the Associate Member Series, Castle Wealth Advisors, and Gary Pittsford, and then we'll get started. As I mentioned, this webinar is a part of a series of educational demos, the second in our series, presented by NCBA CLUSA and our associate members. Associate members of NCBA CLUSA are service providers with a defined expertise, and the aim of this series is to help co-ops navigate certain business challenges that are common to all the sectors. As one of these associate members, Castle Wealth Advisors will explore today the key factors co-ops should consider when planning for the future, including issues affecting family members, options for transition and taxes, retirement, income security, and business and estate planning. Castle Wealth Advisors specializes in coaching co-ops through every step of succession and exit planning and remains dedicated to designing and implementing financial strategies to help owners and members protect their family and their business assets. With that said, please meet Gary Pittsford, President and CEO of Castle Wealth Advisors. Currently working with 25 different co-ops, Gary brings over 4 decades of comprehensive fee-only financial advisory experience to his clientele. His extensive work with co-ops has allowed Castle Wealth Advisors to greater understand the benefits of the co-op model and the benefit to members, ranging from decision-making to profit sharing to increased flexibility when innovation really becomes necessary. A certified financial planner, Gary has also spoken at national conventions and contributed articles for industry-specific and national publications, and his firm has received many accolades for its continued excellent service. So with that said, I'm going to turn the webinar over to Gary, and let's get started.
Thank you, Brian. As Brian said, my name is Gary Pittsford, and I'm in Indianapolis, Indiana. I'm not sure where everybody else is located, but thank you for tuning in. As Brian said, we've worked for about 40 years with lots of co-ops, and we're up to 24, 25, or 26 different co-ops. Some of the larger co-ops in the retail industry. And what we've accumulated the last 40 years is lots of information about helping families transition their company to the next generation or to maybe a new buyer. Helping the store owners, the family-held businesses, is becoming a bigger and bigger concern for all co-op organizations because they want to help the members as they get older. And a lot of co-ops around the United States have an average age of their membership of around 59 or 60 or 61 years of age. So most of the co-op managers realize that somewhere in the next 5 to 10 years there's going to be a change of ownership, and they want to help their members as much as possible. So what I'm going to try and do in the next 55 minutes is touch upon 6 or 7 key areas for the business owner. And if there's anything that we can do to help any co-op officers that are listening in, we can supply you with articles or checklists or anything that you want to try and provide with the financially to help some of your members in your co-op. But let me start going through some of the things that we normally touch upon for every family that we work with. And this is an accumulation of ideas after working with, I don't know, hundreds and hundreds of businesses the last 35, 40 years. So the first, moving the slide, if I can get it to work here. another technical difficulty. Do I have control, Brian?
Yes, sir. It should be working for you.
Maybe I'll get it to work. Yeah. Amy, what?
I think.
Do I have control, Brian?
I believe so. I gave you the keyboard and the mouse. Let me see if I can just. I'm going to make you the presenter, just so it's going to show, I think, your screen.
I apologize, everybody. The wonders of high tech.
Okay, Gary, you are now the presenter. I was attempting to give you the keyboard and the mouse. I guess it wasn't working, but if you want to be able to pull the, there you go. Now we can see your screen.
So do you want me just to pull up the presentation on our end?
Yeah, it looks like that's what we're going to have to do. Sorry for the inconvenience, guys.
Good. Just any choice.
Bear with me here.
Brian, can you see that screen?
Yes, sir. Yep. The first slide, why are closely held family businesses so important to our economy? Looks like you are in control.
What a great question, Brian. Thank you. Okay, moving on. I apologize. Now I only got 52 minutes left. Let's talk about, well, I'll get into the details about how many, but there are lots and lots of family businesses that make up the backbone of the country. And I just wanted the people that are viewing to understand where they all fit in. Roughly, there's about 20,000 great big companies like General Electric or Exxon or Apple. There's about 32 million closely held family businesses, so there's a lot of you out there. About 25 million have 1 or 2 employees. About 6 million have about 15 to 20 employees, and about 500,000 have between 20 and 500 employees. And most of the people listening in, most of the co-op members fit in one of those 3 bullet points. Closely held family businesses are, well, the U.S. Chamber of Commerce defines small business or family businesses as 500 employees or less. And small businesses employ about 69 million people, which is about 54% of the workforce. And all of you working together, all of us working together, do about 50% of all the gross domestic product, everything that we do here in this country. Now, the overview for today I'll go through quickly, but I want you to know that we're going to touch upon business ideas, family ideas, different kinds of transition options. How can I move the stock? How can I sell the business to the children or to employees or to somebody else? How can I get different kinds of retirement security? How can I minimize taxes? And then we'll talk about the kinds of business and legal documents that you're going to need in order to protect yourself. So those are normally the things that a business owner wants to know and before he starts this transition or succession process. There's a lot of moving parts, and every family is different. So that's why no 2 plans are the same. Common questions that people ask us all the time is what is my business really worth? And we'll talk about some basic ideas on how to value the business. How can I minimize taxes is always a big question. How can I sell it either inside the family or outside of the family? And we'll touch upon that. If my children have stock, if you sell or gift 10 or 20 or 30% of the stock to one of your children, what happens if they die in a car wreck, or what happens if they get divorced? And unfortunately, we have two family businesses here in the office where the son died on one of them, and then 3 months later, the father died. And then on others, we have where the father died or the mother died, and it creates all kinds of problems if you don't have the stock and the trust documents set up properly. So we'll touch upon that. Can I afford to retire? If I sell my business and I pay taxes on the profit and I got a bunch of cash left, will that be enough to retire on? So making that decision is always tough for the business owners when they think about selling. Will I have enough? Next, what kind of business do you have? This is usually one of the first questions that we ask everybody, is that when we sit down with them for the first time, we need to know, do you have an S corporation, a C corporation, an LLC, or a partnership of some kind? Because the planning, the choices that we have to make are a little different for each one of those. The other thing that you should consider is that over the last 30 years, from 1980 to 2012, you can see that the top three are the preferred choice. Attorneys and accountants normally recommend that a business either be an S Corp or an LLC, and that's why you've seen it go from 10 million of those types of entities to 30 million. And the C Corp is the most difficult to deal with, especially when you're going to be selling the company, and especially if you're going to be selling the company to a non-family member. You'll wind up paying more taxes, and that makes the C Corp less attractive, and that's why it's actually gone from 2 million down to 1.9 million, and it will continue to dwindle down because of our tax structure that we have in the U.S. The C Corp has a second tax, and the three up above it, you only have one tax. So that's why the top three are the preferred choice. I normally recommend to business owners that we're working with, in most cases, not all of them, but 98% of the time, that either the S Corp or the LLC is the preferred entity to run your business. And then if you own a bunch of real estate, put all that real estate into one or two different LLCs. So the kind of entity that you have will dictate how we do things. And do you have common stock, or do you have voting stock and non-voting stock? So there's a lot of questions that we have to ask about what kind of company you have, which will affect the future process of planning for the company and for the retirement and for the transition. That stock certificate, what is that stock worth? There's 8 or 10 different ways to value a business, to value a corporation. The two most popular are looking at the net assets, which is basically looking at the stockholders' equity and making some adjustments for inventory and assets and liabilities and goodwill. So net assets is one way of looking at valuing a company. The other way of looking at it is called the capitalization of earnings, which is basically looking at how much cash flow there is to work with. Market approach is something that we sometimes use, but for a lot of industries, privately held family businesses are not publicized. So if you sell your business, the Wall Street Journal doesn't call you up and ask you how much you sold it for. So the market approach doesn't have much information, and it's not very helpful for some industries. But the top two are very helpful. Let's look at the first one, which is net assets. This is obviously drywall, which is inventory. Some of you in the grocery business, your inventory is what you have in all your shelves and in the coolers. If you have a hardware store, it's all the inventory. If you have a carpet store, it's the inventory, it's the shelving, it's the computers, it's the signage. So inventory and assets is what makes up stockholders' equity. The next thing, looking at income, here's an example of somebody who had a company, and the profit at the end of the year, the profit was $100,000. But when we looked at the company, we saw that their salary was on the high side compared to national averages. So we were able to add back some salary. what we're doing here is that we're looking for the EBITDA, or adjusted EBITDA, and that's EBITDA, which stands for earnings before income taxes and depreciation. I call it usable cash flow. You know, what does the owner have to work with? He's got the profit, which is $100,000. If he was going to sell the business, we could add back some of the salary because his salary is high. We added back all the interest that he paid the banks, the depreciation. We added back the country club dues because the new owner probably wouldn't join the country club, so that's $10,000 that we have to work with. He was paying excess rent, which was good. I always enjoy, I think people should pay high rent. So we added back some of the excess rent because the new owner would not pay more than just normal fair rent. We added back the one-time expense, and for this gentleman, he spent $20,000 fixing the lighting in one of the stores, which was a one-time expense, so we added back $20,000. And then his health insurance, when he walks away, the new buyer's not going to pay his health insurance, and the 401k matching fund. So at the bottom, when you add it all up, it's $233,000. So for this family, that's the magic number. $233,000 is what they have to work with, and that's the money that we've got to use in order for us to pay taxes, in order to pay the seller, and for the buyer to have some money left over. So it's all got to fit within that $233,000. So that's a very important number. Stockholders' equity is important, but we've got to be able to pay for it. So this number here is what we have to use to pay for everything. Next, what kind of buyers do we have? Over the last 40 years, about 20 to 25% of the people that we have worked with will sell to their children. About another 15 to 20% will sell to key employees because the children don't want to buy the company. They've picked other careers. And then a strategic buyer is somebody else in your co-op, in your organization, in your industry. And that a co-op member would buy out another co-op member normally about 15 to 20% of the time. And each one's a little different. If you're selling to the children, they've probably been working there for 5 or 10 years. So it's an easy transition. They don't have any down payment normally. So it's going to be a long payout, probably 8 to 10 to 12 years. And the terms are going to be flexible. Mom and dad are usually very flexible about the terms on the 10 or 8 or 10 year note. With key employees, it's kind of the same way. The key employees have been there a long time. They're doing a really good job. They're going to be able to manage the company for another 20 years when the owner leaves. So that's an easy transition with a long payout because they don't have a big payment either, a big down payment. Then if it's a strategic purchase, usually that's a quick payout, a quick transition. Normally we'll do those kinds of things on a Friday afternoon at 5 o'clock. The seller will sell the company and the buyer will buy it, and then Monday morning he'll walk in and take over the company. So it's usually a quick transition for most of them. It'll be a short payout, and obviously all the terms are negotiated. Now there's other buyers. I didn't touch upon it because of time, but there's ESOPs. There's all kinds of other ways that you can sell a company, but those are the 3 most common, the 3 most popular. Issues affecting family. Let's move to the next. Let's talk about family instead of businesses. One of my biggest problems or concerns is when I work with a family, I need to know from mom and dad, when do they want to sell? Would they like to sell, you know, a year from now, or 5 years from now, or 8 years from now? But in order to design a blueprint, we need to have a starting point. So it's desirable if we have at least 3 to 5 years to plan for this transition. If we only got 1 or 2 years, we have to move quickly, and it's more difficult. So one of the first questions is, you know, to mom and dad is that, who do you want to sell to, and when do you want to do it? So if it's a 5-year plan, we start, what do we do in 2014? What do we do in 2015, 16, 17, and work our way out. So the question is, how long before mom and dad want to start transitioning the ownership and letting the kids or the new owners or the key employees take over? Next is, if you have children, which children are going to take over? You know, if we have a family that's got 3 children, for example, one of them wants the business, but the other 2 pick different careers. So if we know which child is going to take over, that's very helpful. That speeds up the process. If we have 2 or 3 children working in a business, we need to know which one's going to be president, which one's going to have 51%. I was just talking to some people this morning where they have 2 sons in the business, and also the sons are married, and both of their wives work in the business. So mom and dad want to be fair to all 4 people working in the company. So we run into that a lot. Sometimes it's they have a daughter and the son-in-law has come to work for the family business. So how do we take care of the son and the son-in-law? How do we treat those 2 people differently? So dealing with the children and the in-laws is always an important discussion. Those children are not in the family business, we just touched upon. They picked a different career. Planning for in-laws, we just touched upon. You know, are we going, do they have a son-in-law or a daughter-in-law working there? And for some companies, I'm working with some in Texas right now, where the grandchildren, the grandson or granddaughter, is working for the company, and we're moving ownership to the children and to the grandchildren away from the grandparents. It's very common when we work with a family to be working with 3 or 4 generations in order to move the ownership down to the next level, the next generation. That helps avoid attorney's fees. It helps avoid estate taxes. It helps with income tax planning. There's a lot of reasons to move things instead of just to 1 generation. Sometimes we'll move it to 2 or 3 generations. Next, transition options. What are my options? Let's say you're going to sell the stock or sell the company to children. A lot of parents will gift 20 or 30% of the stock to the children, and then they'll sell the other 60 or 70%. It's very common to go 20, 30%. Some people go 40%. I have up there it says with discounts, because if I give my son 20% of the company, he doesn't have voting control, and he doesn't have any liquidity. It's a very liquid, nobody's going to buy his stock. And so the tax courts have said over the years that his 10, 20, 30, 40% is not worth as much as 51%. So if you're giving away a minority interest, that you can discount that. It depends on the type of company, but the discounts are anywhere from around 25% to 35% of a discount. So I can gift some stock to the next generation. I can also sell some stock. So let's say we gift 40% and we can sell the other 60% with an installment note where they make payments just like a mortgage, and they pay off the rest of the company over time, which gives mom and dad a retirement income. And mom and dad would have collateral in the business to help protect that note. Or sometimes what we'll do is we'll gift them 10 or 20%, maybe 30, and then we let them run the business for 2 or 3 years, develop a good track record of running a profitable company, and then they could go to a local bank and get a loan, like an SBA loan, and use that loan to buy the rest of the stock. So mom and dad, instead of getting 10 years of payments, mom and dad would get one lump sum check. But sometimes we'll use a bank. SBA loans are more common the last 1 to 2 years. If you go back 5 or 6 years, it was very, very difficult to get an SBA loan, but it's becoming more common nowadays, especially if we have a child that's been running the company for 3 or 4 years and has a good track record and good profitable tax returns. Sometimes we'll use voting and non-voting stock. For most of the co-op members, the company that they have is their first or second biggest asset. So if we're giving the biggest asset or selling the biggest asset to one child, how do you protect the other children? So sometimes the one getting the company would get voting stock, and the other kids might get non-voting stock in order to be fair. Because mom and dad, they tell me that, well, we've got 3 children. We want to be fair to all 3, but we want one son to get this, but the other kids to get something else. So sometimes we have to use different kinds of stock in the estate planning and in the wealth management decisions. Who's going to keep the voting control? Normally that would be to the son or daughter, who's going to have voting control and be president and run the company. And if I don't do anything, when I die, the stock will go through my estate. It'll go through lawyers will make probate fees. We may have to pay estate taxes, and then the stock will be transferred based upon my will. And that's a very expensive way to do things. Next. These are different types of retirement income. So if I sold my business, if I gave my son 40% of the stock and he bought 60%, so the top line talks about selling that other 60%. The next one is that sometimes for tax reasons, we might, the company might give me a consulting contract. Sometimes we call it a non-compete contract. So the company would pay me consulting fees as part of the overall transaction. There's tax reasons for that. Sometimes I might sell goodwill. Sometimes I might continue to work there for the next 4 or 5 years and get paid a salary based upon how much time I'm there. Sometimes I might increase the rent. You know, if I've been charging low rent, and if I sell the company to my children, or if I sell the company to key employees, I might have them pay high rent, which is deductible to the company, and that rent would go into my LLC, and I might have some depreciation over there to help shelter that. Sometimes I might be on the board of directors. My wife and I might get paid director's fees to be on the board and to continue to help the employees or the children run the business. It's quite common for the retiring president to be on the board for, it could be 10 or 15 more years. Sometimes we'll pay deferred compensation to the retiring president. Sometimes they normally would have IRA or retirement type accounts, and they may have personal assets. They may own some other real estate where they're receiving rental income. They may have some stocks and bonds. So those are many different ways of getting paid. Usually when you sell a company, especially to children or key employees, you'll wind up using 2 or maybe 3 of those ideas. You don't use them all, and you probably don't use just one. 2 or 3 will help you with saving taxes. So those are different ideas on how to get paid when you sell the company. Next is taxes. When you sell the company, you know, it depends on the seller, could be in the 35 or 39% tax bracket, and the buyer might be in the 30 or 35 or 39% tax bracket. Some of these items might be deductible and some are not. So your accountants are very important in calculating the taxes, and if a business owner is listening, 2 or 3 years before you sell the company, have your accountants calculate the taxes. If I sell my business for X amount of money, what will my taxes be? And get to know that ahead of time and start working on ideas on how I can reduce taxes. Next is, in 2013, we have a new tax law. You've all, probably most of you have paid your taxes by now, and my guess is that for most of you, your taxes went up in 2013 versus 2012. So for 2013 and 14, the maximum tax bracket is now 39.6, and capital gains is actually 23.8, almost 24% on capital gains. So if you're thinking about selling the company to another member of your co-op and you're going to get one big check, you might think that capital gains is 15%, but it's really 23.8, almost 24%. And you may also have some state taxes depending upon what state you're in that you're listening. If you're above 250,000 of income, your income is going to, your maximum bracket is going to be 35%, and capital gains will be almost 19. It's 18.8%. So taxes are an important thing to think about. When I talked about gifting 20 or 30% of the company, I should mention that there's two different gift tax rules. I can give $14,000 worth of stock, of assets, I should say, to my children or to whoever. But that $14,000 includes birthday presents and Christmas presents. So I always tell parents, if you're gifting assets to your children, always give $13,000, don't use $14,000. And then the maximum gift is $5.3 million, which is also the same number for estate taxes. So if you're married, both spouses have 5.3, so the total would be 10.6 million. So if your estate is anywhere around 8 or 9 or 10 million, you've got some definite tax planning to do. If your estate is 1, 2, 3, or 4 million, counting all assets, all life insurance, all of your retirement accounts, everything that would go into your net worth, then if it's in that 1, 2, 3, 4 million range, what you could do is that you could give, let's say you wanted to give your children $500,000 of company stock. We could subtract that $500,000 from the $5,300,000, and then you'd have $4.8 million left. So I can either use that $5 million either by making gifts or when I die. So you have one or the other. But that's a great way to start moving assets, especially if you have a company that's growing at 10 or 12 or 15% a year. You want to get that asset out of your estate so that it's growing in somebody else's estate, preferably one of the children that's younger than you are. So move it down to the next generation. So that's gifting. The other two things that we were able to keep, Congress was going to do away with LLCs and the discounts, but when they finished the law back in 2012 and 2013, we were able to keep these. These are important planning tools. The family limited partnerships and the LLCs and the discounts are very important for families being able to move assets to the next generation. These are really important tools. Most tax attorneys use these ideas all the time, just like we do. What's next? Business and estate documents. We normally suggest for people that are stockholders of a company, especially if you have 51% or more, if you have voting control of a company, you need some legal documents to protect you and the stock. It doesn't matter what the company is worth. The company might be worth $1 million or it could be worth $50 million. It doesn't matter. If you become disabled, you have voting control. So somebody's got to vote that stock for you, and you need to put in writing who that would be. So these are the 7 most common documents that we use with about everybody. The 2 at the bottom, the durable power of attorney for health care and the general durable power for financial care. If I had a car wreck and I was laid up, or if I have Alzheimer's, while I'm alive, I give somebody in those last 2 documents the general durable power. My wife or my son or my daughter, or I give somebody the power to make healthcare decisions and to make financial decisions. So if I'm alive, those two bottom documents are very important because somebody's going to vote my stock if I'm laid up for 6 months. Or if I have Alzheimer's, I could be laid up for several years. If I'm dead, if I have a car wreck and I'm dead, then the top line becomes very important, my will and my trust. The trustee of my trust and the executor of my will take over and control my assets. Then one that I didn't mention is called a stock redemption agreement. Some people call them a buy-sell agreement. That's probably the most important document if you're a business owner. Because if you die next month the first thing that I need to see is the stock redemption agreement and to see what you signed and what the provisions are. Because the stock redemption agreement controls that stock. So if I give stock to my son or daughter, they need to sign a stock redemption agreement which controls their stock in case of death or divorce or disability, or personal bankruptcy. Whatever could go wrong, they're covered, and the company is protected by that stock redemption agreement. So you need up-to-date wills and trusts that are prepared by good estate tax attorneys that know what they're doing. A corporate attorney, or sometimes the estate attorneys, can prepare stock redemption agreements, and then they would also prepare the bottom two durable powers. The other two in the middle, the business letter, we usually recommend that the business owner write a letter and say that if I have a car wreck tomorrow, I want this person to open and close the store. I want this person to sign checks. I want this person to be able to order inventory. I want my vendors to know if I'm laid up, this person is going to be in control of the company. So you need to have a business letter so that everybody working there knows who you want doing which job. And then the personal letter is helpful because most of us in the 60s and 70s and 80 years of age, it's hard to tell your children what your thoughts are about your assets, about the company, about what's in the wills and trusts. And if you would write a simple letter and put it in with your wills, and in that letter you just simply say, I wanted this person to run the company because I think they're best qualified. I want this person to get some of the real estate. I want this person to get life insurance. I want this person to get something else. And here's why I'm doing all of this, because it really helps. When the parents die, and I'm working on 3 different businesses right now where the children were never told what's going on, so it's easy for the children to start fighting among themselves because they didn't know what their mother and father were thinking. So if you can kind of explain to them ahead of time and put it in writing, it's of great help. Now, let's go to the stock redemption agreement. If you look at the last line, if you're a business owner and you think you have a buy-sell agreement, pull it out and look at it and make sure that you've got a paragraph in there that talks about what happens to the stock in case of death. If I died, the company would buy my stock, or my other children or somebody would buy the stock. In case of a divorce, nobody outside the family can own the stock. In case of personal bankruptcy, nobody outside the family can own the stock. In case of Alzheimer's or a car wreck which causes a major disability, the company can buy the stock back, usually after about 12 months, or termination or retirement. So there should be a paragraph for every one of those, what we call trigger points. And if you talk with your lawyer and ask your lawyer if your document covers all of these trigger points, and if he doesn't understand what trigger points are, then I suggest that you look for a new lawyer. Trigger points is a very common term with buy-sell agreements, and each of these are trigger points that cause something to happen. So it's important that those documents have all those ideas, and very few do. I read lots of buy-sell agreements, probably 2 or 3 a month, and most of them do not cover all those items. I'll tell you, death obviously is a problem, but the 2 that I see most often, that I have to deal with most often, are divorce and disability. So make sure your documents cover all of those items. Next, who's going to help you do all this? You need to put together a group of advisors. I normally suggest that you have a business attorney or an estate tax attorney, and sometimes a estate tax attorney can help you with the buy-sell agreements. If you own lots of real estate, you may want a real estate lawyer. But 1 or 2 lawyers need to be on your team helping you design this blueprint that you're going to create to sell the company. Your accountants need to be able to handle the business taxes and your personal taxes. And you need a financial advisor of some kind who's going to help you with your assets. it's kind of difficult for a business owner. You're moving from owning a company with stockholders' equity. You're getting a salary and probably a bonus every year. And you're moving away from that to becoming, you have a big check, or you have checks coming in, and you've got liquid assets, and you're going to be living off of interest, dividends, and capital gains. That's totally different. So you need a group of advisors, attorneys, accountants, and financial people who can help protect the assets that you've accumulated. As I put down there, I normally suggest that when you pick a financial advisor, pick a fee-only person who doesn't sell anything, is not getting paid commissions, a fiduciary who has to do what's best for you, and an independent person where they work for their own company. They don't work for some big organization. So an independent financial advisor, an independent accountant, and an independent lawyer to help you design this plan. And a banker may come in handy that understands family businesses if you think you're going to be needing an SBA loan, maybe for the children to buy you out later. So you need to talk to these people a couple of hours every year for 2 or 3 years before the sale. But then the last couple of years, when you're getting real close to selling the company, meet with them every 6 months, pick their brains, talk about ideas to save taxes. How do I transfer? How do I make a gift? How much should the gift be? Get the plan all worked out ahead of time and spend time with these people. I know it's going to cost money, but if you spend $2,000 or $3,000 a year working with these advisors, it can easily save you $50,000 or $100,000 a year in taxes. So these are important people. So pick good ones who have worked with lots of family businesses in the past. Minimizing or maximizing, I'm sorry, I got to get these glasses fixed. Maximizing value. 2 or 3 years ago, somebody asked me, what should I be doing to get ready to sell? I don't know what's the first thing to do. So I put together this simple 3-year plan. If you're going to be selling the company in about 3 years from now, here's what you should be doing 36 months out. Start cleaning up your financial statements. When I look at financial statements that come in here every week, I see loans to stockholders, or loans to stockholders, or loans from stockholders, or loans that don't need to be on there. Anything that's on the financial statement that's going to cause a buyer to ask questions, if you can get rid of it, clean it up. Clean up the financials. Reduce expenses. Reduce payroll. Increase margins. If you have a retail type business, in the last 3 years, if you could increase your margin 0.5% to maybe 1% a year, that's going to put a lot of money on the bottom line. Try to increase your margins just a little bit. Try to decrease your expenses a little bit, maybe 1 or 2% a year. The biggest expense you have is payroll. The second biggest expense you have is rent. Payroll is usually the biggest problem for most people. And if you can reduce your payroll 1 or 2% a year for the last 3 years, you'll add a lot of value to the company, and you'll increase that usable cash flow that we have to have in order for somebody to buy you out. So work on your financials and work on your expenses. If you're 2 years out, so you got 3 years to do that first part. You got 2 years out. Start working with your people. Make sure you hire the right kind of people. You've got them in the right job. You've got them well trained. If the buyer is looking at the business, they're going to want to see the last 2 or 3 years tax returns and the last 2 or 3 years financial statements if they're serious about buying your business. The second question they're going to ask you about is the people. Tell me about your key managers. How well trained are they? What kind of schools have they been to? How long have they been with you? You know, so your people are very important. It adds value to the business. And then if you got 12 months to go before you sell the company, start cleaning up the building. Paint everything inside and out. Fill up all the potholes. Make sure the signage outside the building is working right in daytime and nighttime. So make the place look good. That's another thing that a buyer looks at. If he drives by at night and your sign isn't working at night, it just causes him to think, well, what else is not working? Or what else didn't they fix? So don't give them anything to think about. So make everything look good. So this is kind of a simple 3-year plan that you can do if you're going to be selling the company in about 3 years from now. Next, what's next? Here's a quick summary. We got about 10 minutes to go. We talked about we've got to value the stock if we're going to be selling it to children. If we're going to transition it, we can transition the leadership. For example, I could let my son become the president and take over the leadership maybe in 1, 2, or 3 years. But the stock, I might develop an 8-year plan to move the stock to that son or to 2 or 3 children over an 8 or 10-year period. So they don't have to be, the transition doesn't have to be the same timeline. Usually transitioning the leadership is quicker and the stock might take longer. Clean up the financials, like I said. Decide what you're going to do for children inside the company and outside the company. If you're going to deal with a non-family buyer, whether it's a key employee or somebody else in the industry, have your accountants and attorneys work on minimizing the taxes, reduce the taxes for you and for the children if they're the buyers, and for the company, especially if you have a C Corp. So I need to calculate the taxes for all 3 of those different people. Next, retirement income. Before you sell the company, have your financial advisors and your accountants work on what's my retirement income going to look like if I sell the business for X and I pay taxes and I've got so much left. What is my retirement income going to look like? Estimate that for me. Do it ahead of time. Aggregate all of the asset allocation. What that means is I may have a chunk of cash. I may have an IRA. I'm going to have, maybe I own some, and how much is in real estate, how much is in retirement accounts, how much is in personal cash. Make sure you've got the right allocation in the right category depending upon the economy that we have today. Right now we have an economy where the stock market is very high, interest rates are very low, inflation is kind of in the middle, so you want to allocate everything to protect you. And that deals with the wealth management, which ties back into the attorney, your accountant, and your financial advisors to help you work on any changes that may be necessary for your wills, your trusts, your family, maybe gifting, assets that you want to give to charities, tax planning, it would be gift tax planning or estate tax planning, and all of that ties back into your net worth. And the biggest asset that most of you have in your net worth is your company. It's either the company or the real estate. So all of this ties together if you're thinking about transitioning the company. Oh, and this is just a picture of a typical 3 generations. So when you're thinking about this, working with your advisors, these are the things that we do is we try and do what's best for grandma and grandpa, and then what's best for the son or daughter taking over, and what can we do for the grandchildren, and how can we save taxes and move assets efficiently from one generation to the next. So be thinking about 3 or 4 generations. This is just a slide that shows that Castle Wealth helps business owners with all of those things at the top. We kind of help build the blueprint for families. And this is just a page. Brian and I talked about this. It just shows a lot of the different co-ops throughout the United States that we've worked with over and over for many, many years. So it just shows that we know the co-op industry. We really enjoy working with co-ops. I enjoy working with the NCBA and all the co-op members that are represented in Washington. So this is just some of the co-ops that we work with. This is, if you're interested, our website is castle3.com. And I just wanted you to know that if you look under articles, the 3rd one down talks about business concepts. And if you go to that, you can read articles, you can print them off, you can click on wills, trusts, stock redemption agreements, selling to my children, how can I increase the value of my business? There's all kinds of articles there that we've written in the last 4 or 5 years. And then down at the very bottom is an ugly face. But there's some videos about selling inside the business or inside the family, or selling outside the family, or succession planning. But those videos are 3 or 4 minutes long, so you might be able to pick up something from the video or from reading the articles. So all of that whole page is just like a library for you to use if you want to read and understand more information. And that's it. You can go to, like I said, there in the middle, castletree.com or Castle Wealth Advisors if you want to read any of that stuff in our library. And I think, Brian, I'll turn it back to you for anybody that had a question.
Yeah, absolutely. Thank you so much for that, Gary. That was great. I'm going to open it up now for the Q&A. If we've got about 20 participants or so, if anybody has a question, we do have some time left, and we're happy to answer that for you.
They're probably all gone to sleep by now. I hope I haven't bored everybody.
No way, Gary. It's some really good stuff, and I think that a lot of the co-ops that you've worked with, I'm sure they would attest to the great work that you do. Looks like we have a question coming. We do have a question. Here we go. Let's see here. Does the company remain a co-op? What about selling to multiple stakeholders, i.e. family, employees, customers, and vendors? So it sounds like they're asking if in the transition, if the company can remain a co-op, Gary.
Well, what we were talking about was a husband and wife, or a wife or a man that own a company. Let's say it's a hardware store or a grocery store. It would be an S corp or a C corp, but that is set up under federal law and state law. They usually get a state charter and they get a federal ID from the IRS. So that company does not have to be a member of a co-op, but they elect to do so. That family has elected to join a co-op, and they would continue to be a co-op. So an easy example is that mom and dad sold an IGA grocery store to their children. Children would also probably remain a member of the IGA co-op.
Okay. Second question here is, you mentioned that C Corp is the least desirable. What is the process of changing to an S Corp or LLC?
The normal method of transfer or transition is that the IRS has a special code where if you have a C Corp, you can switch it to an S Corp, but before you do that, talk to your accountant. There may be a little bit of tax to pay on that, but in the long run, it's almost always more desirable to be an S Corp in the future. So, but if you switch it from a C Corp to an S Corp, if you did it in 2014 in the month of June, you'd have to stay an S Corp for 10 years. So mom and dad can change it from a C Corp to an S Corp, and if they sell it to the kids would have to keep that company for 10 years. The IRS won't let you switch it from a C Corp to an S Corp and then a year later sell the business, because it's a big advantage to go from C to S, and the IRS knows that, so they make you keep it for 10 years. A lot of times what we'll do is that mom and dad will sell the C Corp to the children, and the children are going to keep it for at least 15 or 20 years. So the children will then flip it to an S Corp, and they keep it for 10 years. As long as they keep it and run it like a normal company for 10 years, then you can do that switch, and a lot of people do that. Now, you can't switch it. The normal process is switch it from a C Corp to an S Corp. There's no automatic process to go from C Corp to LLC. So if anybody's thinking about changing, the best choice would be to go from a C Corp to an S Corp and then keep it for 10 years.
Gotcha. Another question, what does a business evaluation cost?
A lot. No, I'm kidding. Most valuation companies charge anywhere from about $8,000 to $15,000. We have 4 companies, and one of our companies is Castle Valuation Group. And for the industries that we work in, and you may find this in some other industries too, like the agricultural industry, which is a big chunk of the NCBA. But when we have to spend about 20 to 25 hours analyzing a company, and that's usually about $4,000 to $5,000, because the industries that were on that page back there that we specialize in, we know so well, it's easier to do them quicker. So I guess the answer is it's going to cost $4,000 to $5,000, or it may cost, depending on who you hire, it could cost from $8,000 to $15,000. There's a lot of work involved. It's not an easy process going through 4 to 5 years of tax returns and 4 to 5 years of financial statements and going through inventory and accounts receivable and a lot of other stuff. Just takes time. So that's about what it costs.
Gotcha. Another one, we get occasional faxes and letters from businesses that claim to have clients ready to buy businesses. Are these qualified buyers normally?
When you get that kind of a letter, throw it in the wastebasket, or if that person calls you, hang up real quick. I have found over the years that business brokers, they promise a lot, but it's hard for them to deliver. I was trying to be funny a minute ago, but seriously, I have not found very many business brokers that can really do a good job. I would not pay anybody $10,000, $15,000, $20,000 to put together a fancy brochure, and then 1 or 2 years later they still haven't found a buyer. I've had business brokers call and tell me that they have buyers from Canada or from Europe that want to buy a hardware store in Des Moines, Iowa. And I said, you really got somebody in Europe that wants to buy a hardware store in Des Moines, Iowa? So you got to be real careful about some of these brokers or business brokers. Most of them promise a lot but don't deliver. There's 1 or 2 companies that have been around a long time, but just be very careful. They're probably not going to sell the business for the price that you want. The other thing that happens is that privacy goes out the window. If you're in a competitive market, you don't want your competitors 5 or 10 or 20 miles away to know that you're going to be selling your company. But when you deal with a business broker, they're going to notify a lot of people that your business is for sale. So the word's going to get out that you're for sale. So you want to be careful about privacy. It's very difficult. So just don't believe everything you hear. I guess I should shut up at that point.
No, that's great insight, Gary. It looks like that's the final question that we have here. This presentation will be available to the attendees for download, and we will certainly send a survey and love to hear your feedback on this. With that, Gary, I mean, if there's anything else to say, we looks like we're all done here, and we appreciate everybody for coming. If you have any final words or anything, we're happy to hear them. Otherwise, we are ready to sign off.
Well, the only thing I would summarize is that I hope that some of this information could help the business owners that are listening, and also this information might be able to help some of the co-op leaders, the officers that run the co-ops, because they want to help their members, and hopefully some of this information can help them. So I hope it was helpful to everybody. Thank you.
Absolutely. We appreciate your time, Gary, and thanks again for everybody for coming out. Our next webinar will be coming up in July, and we will be letting you know all about that, so please be sure to stay in touch. Thanks again, and enjoy the rest of your week.
Thank you. Thanks, Brian.
No problem.
Bye.
Bye.